Okay, so subject is capital markets and the topic is interest rates and their role in finance. This is the fifth video out of the 5 videos for this particular topic. So I just have the chapter summary. So summary of all the videos. First 4 videos that we've had about interest rates. Okay. Interest rate denotes percentage earnings or yield on investment. So we have two perspectives from the depositor or investor. So it's interest income for them. And then for the borrower or the businesses or individuals that needs the funding, so it's interest expense for them. Okay. It is the cost of using money expressed as a percentage of the principal for a given period of time, which is usually per year. Interest rates are normally expressed on, as an annual rate. Interest rate fluctuates and affects market prices of securities in the financial market. Depending on, we have the monetary board and they have this monetary policy to ensure that there would be price stability in our economy, in our financial system, and in that case, they do monitor and supervise and try to control the inflation rates, and they do that normally by changing the interest rates. Okay. The amount of money that people desire to hold is the demand for money. Higher prices increase the quantity of money demanded. Okay. So how do we explain this again? So demand for money, it's not, how much money you want to have. It's actually out of the money that you do have, how much of it do you retain in the currency form? Okay. How much of it do you save and not spend in, buying goods or services? Higher prices increase the quantity of money demanded because, with higher prices, people tend to, they're discouraged from buying. Instead of buying it now, they probably wait it out. They would expect that the prices might go down still. So instead of buying those goods and services now, they would hold on to the money and wait for the prices to go down. Okay. So in that sense, the quantity of money demanded increases. Okay, because they keep the money in currency form. Types of demand for money are transaction demand, precautionary demand, and speculative demand. Transaction demand, so they're going to use it for their daily lives, their meals, utilities, rent, and others. Okay, and then precautionary demand, building your emergency fund for contingency or emergency situations. And then you have your speculative demand if you're an investor and you feel that holding onto your money now would be more beneficial, and then waiting for a certain event to happen before you spend your money. So that's speculative. Okay. Velocity of money is defined as the number of times that a unit of money is spent on the total value of goods and services produced per year. The demand for money has an inverse relationship with the velocity of money. If the demand for money is low because the interest rates are high, the turnover of velocity of money increases. Okay, velocity of money is, how often it changes hands in the market or in the economy. So if there is a high demand for money, meaning the people are holding onto their cash, then there would be less money circulating in the economy. And because there's less money, the velocity of money decreases. Okay. Normally that happens when interest rates are high. If the demand for money is low, okay, if the demand for money is low because interest rates are high, then the turnover or velocity of money increases, okay? Interest rates are high, so the borrowers, they are not looking forward to borrowing money because the cost of borrowing would be high. And so they just use whatever money that they have. And so whatever money they have, they use them to buy goods and services. And because they've used it, the money goes out into the market, into the economy, and that helps in the velocity of money. Okay. Interest is a determining factor for demand for money, velocity of money, and prices. There are different types of interest, and among these are nominal, real, compound, fixed rate, and variable or floating rate. Rate of return defined as the payments to the owner plus the change in the value of the investment, expressed as a fraction of the purchase price. Okay. Central banks use interest rates to control money supply, demand for money, reserve requirements, and other monetary tools to maintain a healthy and stable economy. Okay. If there's too much money in the market, that could lead to inflation, so they would want to, have a contractionary economy, or, slow down the market. So they can do that by increasing the interest rates, or by increasing the reserve requirements, so that there would be less money in the market or in the economy. Okay? Interest rates play important roles in the economy, including helping guarantee that current savings will flow into investment to promote economic growth. So if the interest rates are high, normally the savers or the investors would be encouraged to put their money in the bank, so that, or in the capital market, so that they would earn more for their money. And so since their money is now in the capital market, it would now fund businesses or borrowers, their production, or whatever economic activity they are involved with. And that would promote economic activity or economic growth. They could, expand their operations, increase their production. They could hire more people, contributing as well to high employment rate. Okay. Rationing the available supply of credit, because, capital markets, they would assess the borrowers, whether they are capable of using this money and make profits out of it, or if they're not, not, what do you call that? Limutan ko na. They haven't proven themselves yet that they could make their businesses profitable. Okay? I forgot what it's called in English. Anyway. Bringing into balance the supply of money with the public's demand for money. So the capital market would, of course, assess how much money they are receiving from the savers and the depositors, and they would, in a way, balance it out with how much money the borrowers would need for their, funding needs. And then acting as an important tool of government policy, because again, they want price stability. They're trying to control the rate of inflation. Pure or risk-free interest rate, a component of all interest rates, is usually the one associated with government securities, because government securities are generally risk-free. Okay. There exist theories concerning the determinants of the pure or risk-free interest rate, classical theory, loanable funds theory, liquidity preference, and then rational expectations theory. Okay? Classical theory states that interest rates in the financial markets were determined by the interplay of the supply of savings and the demand for investment. Loanable funds theory posits that borrowers create the demand for loanable funds, yes, and the lenders on the other side of the market seek to provide the loanable funds needed by the borrowers. To be honest, I feel that they're essentially the same. Okay, but just different wordings and probably different perspectives. Liquidity preference theory stipulates that the interest rate is determined in the money market by the money demand and the money supply. Essentially, all of them has something to do with supply and demand. Okay. Rational expectations theory is based on the premise that the financial markets are highly efficient institutions in digesting new information affecting interest rates and security prices. Okay, so this one is more on the availability of new information that would affect decisions. Okay? Among the major determinants of interest rates are inflation expectations, monetary policy, business cycle, and then government budget deficits. Interest rate is measured through simple interest, effective interest, or yield to maturity, and real interest rate. Simple interest rate, ratio of the interest earned or paid to the capital. Effective interest rate is based on the kind of credit obtained or granted. So for trade credit, the cost of the foregoing, the discount granted by the supplier. So the discount over total amount minus discount times 1 over the term in excess of the discount period over 360. Okay. For bank loans with compensating balance requirement, EIR would be interest over the cash proceeds times 1 over the term of the loan. Yield to maturity is the internal rate of return, current yield, yearly coupon payment divided by the price of the security. Okay. Yield at a discount basis computed as face value minus the purchase price over the face value times 360 over days to maturity. Real interest rate adjusted for expected changes in the price level so that it more accurately reflects the true cost of borrowing, real. It is more accurately defined by the Fisher equation. Nominal rate equals real interest rate plus the expected rate of inflation, or real interest rate is the nominal rate minus the expected rate of inflation. Essentially, the effect of inflation would lower the actual rate, or that's why the real interest rate is normally lower than the nominal rate. And again, this is from the perspective of investors. Okay, so that's it for this one. We're finally done with the topic interest rates and their role in finance. All right, so that's it. Thanks and bye.